Research at Citi, Markets Edition.
Hi, I'm Scott Kronert, head of U.S. equity strategy at Citi Research, and have also been leading our ETF research charge over the past 14 years now. Welcome to Research at Citi, Markets Edition, covering various topics of work within the U.S. equity markets. With me today is Drew Pettit, my longtime colleague, who's been leading the charge on ETFs over the past couple of years. We've invited Drew to discuss a recent note that we've put out that has looked at the longer-term AUM opportunity for US listed ETFs, with a lot of the sidebar discussions as to what's happening under the surface here. To start things off, as I mentioned, we've been covering ETFs for the better part of 14 years now, and we've gone from a circumstance where 10, 12 years ago, in many cases, ETFs were often viewed as the enemy to many different types of portfolio managers and portfolio construction. How the world has changed. Over the past decade, and I think courtesy of the pandemic episode, we've seen the ETF ecosystem unfold in ways that we might not have imagined. And to that point, following Drew's good work on this topic, we've aggressively raised our targets for aggregate US listed ETF AUM. And so let's kick things off here, Drew, with a quick description of what we're doing at a very high level here.
Yeah, so we're taking the story that you were telling right in that intro that ETFs aren't the enemy. A lot of asset managers, even the actively managed community, is looking at ETFs as a growth engine for their business. And really, the growth just continues to accelerate and surprise us to the upside. Look, in the last report, we put out new targets. We're thinking assets at the end of this decade by 2030 can hit 25 trillion. That's from about, let's call it 13 trillion at the end of last year. And then in the next 10 years, we might actually see AUM, so total assets of the US ETF industry, breaching 40 trillion. That's really impressive growth. And the story under the surface is it's not just index and passive products. Active is moving to center stage.
Okay, so this notion of active moving to center stage, we've been talking about this, it seems like, for several years now. This is clearly, let's call it the next gen wave of growth. I think in the note we've talked about its market share within aggregate ETFs. How are you seeing that play out now?
So it's about 10% today, at least how we define it. And in the next 10 years, we think that can double. And when you break it down, you're going to get more organic growth. More people want these types of products. It's not really the market driving the asset growth for active. So yeah, from a 10% kind of share of the industry today to over 20% in 10 years.
So essentially what happens here is that the investors get a combination of looks into the investment opportunity set. You can continue to use ETFs, low-cost passive index replication, as one approach, but now increasingly what we're seeing is the growth in the active component here perhaps begin to eat into some of the market share that mutual funds have had over time, which we've elaborated on over the past several years. But more specifically to the point here, this notion of how to think about index or portfolio construction and the core component of this versus, let's call it the more satellite component of this. Essentially what you get now is an opportunity to look at this core versus satellite component to index construction via either of a passive or active approach. Drew, kind of weigh in on and give us a little bit more perspective on that with a line of sight towards how you think about equities versus fixed income in this.
So I'm going to back up and define this. Whether you're an individual or a very complex institution, there's really two parts of your portfolio. The core, which is your base building blocks, really broad exposure to equities or fixed income. And then there's the satellite. The satellites are the nuanced things that you add on the fringes to make that portfolio fit your circumstance. When we think about the core, that used to be all low-cost index product. Now we're starting to see more active product float in here. And what's happening is indexes are changing over time. We talk about this in a lot of our work in equity strategy, and you've done it on previous podcasts, that the S&P has a lot more growth in it today, less cyclicality, less defensiveness. So the indexes are drifting, and we're seeing clients use core active products to get some risk that actually doesn't drift as much, that has a security selection overlay that really generates what they want longer term. In fixed income, that's also happened. As interest rates have come down, you get less yield off of traditional indexes. You get more interest rate risk. People have been using active for a really long time to get core exposure that actually fits what they need a little bit better. So they're being more opportunistic there.
Okay, so essentially what's happening here, and this is, again, this is a trend that we've been defining, it seems like for several years now, and this core plus satellite approach is a means to getting to an asset allocation solution. It's going to vary by type of investor, time horizons, and so forth. I want to just hammer on a couple of underlying, let's call it definitional dynamics at work here. So we've argued for some time that you can actually get an actively managed portfolio solution by essentially utilizing passive ETF products. So it's this passive for active implementation that has been relevant, but increasingly the composition of where active solutions are taking us can actually help get to a same place. But it kind of comes down to, again, core plus satellite. Drew, let's switch over and talk to some of the specifics around this notion of satellite, again, through both an equity and a fixed income lens.
Yeah, I think your setup for this was great because back to passive or index doesn't necessarily mean it's just broad and buys everything. So some of the satellite trends, there's really three big ones that investors as a whole like to add around the core. So number one, they're looking for growth, really secular growth trends. You can go out and buy a tech index product, or you can buy an active thematic product for that. So we've actually seen a lot of incursion of active strategies for people looking to add more growth to their portfolios. The second really big trend is wanting to add a cyclical satellite. I want something that grows alongside the economy, for example. Look, this is something that's not necessarily just an equity story. You can get that buying value stocks. You can get that buying high yield bonds, for example. So within those areas, there's a lot of risk. So we're seeing people move to active to really manage some of that cyclical fluctuation within that satellite. And the last one, and probably a huge one for a lot of our pension and insurance clients and a lot of aging individuals, is income. And the first thing that comes to mind when people think about income is fixed income products. And active is able to go into corners of the fixed income universe that passive actually hasn't indexed very well. The other angle is there's other drivers, other ways to get yield in a portfolio. And we're seeing a lot with derivatives-based ETFs. And again, both of those, whether it's active in fixed income, looking for different areas to get yield, or active in equities, using derivatives as a way to, I would say, pull forward some of that return, you're seeing that shift from just passive products to get these satellites to active ways of implementing.
Gotcha. Very interesting. Okay, so to wrap all of this up in our allotted time, big picture here, big picture for my perch, the ETF universe continues to expand in terms of nature and type of product. Increasingly, we're seeing a shift over time away from the traditional passive to active. And this is not a new theme. It's been identified for quite some time. But I think what we also are acknowledging here is that the nature of the markets change over time. And in the post, let's call it financial crisis world, for example, in equities, it's just been hold your core S&P 500 and you've done pretty well. In fixed income, it's been a little bit more nuanced, but I think in this world is changing and continues to evolve narrative, the onslaught of active solutions and products within the ETF ecosystem, we think just keeps giving the investor opportunity set more and more ways to accomplish portfolio purposes. And ultimately, I think we, again, as I started out the podcast with this, hey, we've been doing this for 14 years narrative, I think from this point going forward, it sure looks and feels to us that whether it's active, whether it's passive, whether it's equity, whether it's fixed income, fact of the matter is that the normalization of ETFs into the traditional investment playbook continues to be a major story as we charge forward from here. For further information on this note, I think it's a really good write-up. Drew's put a ton of effort into the diligence around this, and we encourage all of you to reach out for further insight on this. This podcast was recorded on April 13th, 2026. Thanks for joining today, and be sure to be on the lookout for our next Markets podcast featuring Dirk Willer, Citi's Global Head of Asset Allocation, and also be sure to watch for other Research at Citi podcasts, which you can also view on the same channel. Thanks and have a great day.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup, Inc. or its affiliates and are used and registered throughout the world.